Hey everyone, today we're going to be looking at projecting cash flows of a project via pro forma. Okay, so let's begin. Now, before we begin looking at this particular objective, I don't want to start getting into all this content and all this work straight away. What I want to do is explain to you the context behind why we're studying this particular thing we called pro forma and whatnot. So in these past lessons, we have been looking at a couple of things. Okay, the first of these things is that we are a firm. We are a firm or business, whatever you want to call yourself. And there's a financial manager running this business, right? Now, as a financial manager, we want to undertake projects to increase shareholders value. Okay, that's our objective. It's to take on projects to increase, or I should probably say maximize. We want to maximize shareholders value. And so a question that we have to ask ourselves is, which projects do we accept or reject? So which projects are we going to accept and which projects are we going to reject? Right, we've been covering these things in the last few lessons. So are we going to accept this project or reject this project? And we looked at valuation methods, didn't we? Like the NPV, payback period valuation methods, NPV, PP, internal rate of return and stuff like that. So we looked at valuation methods to determine this. Now, something that we have to just realize is that these valuation methods, they require future cash flows, don't they? They require future cash flows. So we can't do these valuation methods unless we have the future cash flows. Okay? And so this leads on to what we're studying today, because if we require future cash flows, then we have to learn. We have to learn how to forecast these cash flows. Okay? If I need future cash flows, well, I'm going to have to learn how to forecast them, and we have to make sure we forecast these appropriately, because there are going to be estimates. They are estimates because these are estimates, because these are estimates, alright? So we want to pick the closest representation of what our project will come to. And so to forecast these cash flows, we use things known as pro formas. Okay? And before I talk about pro formas, let's look at its definition. So a pro forma are financial statements used in forecasting a project's cash flows / operations. Okay, so in order to forecast the cash flows, we use these financial documents, these financial statements, which allow us to forecast cash flows. So let's begin. And before we begin, I want to look straight away at, how do we calculate a cash flow for a particular year, right? Because we're looking at, forecasting cash flows, so it'd be best to look at the formula itself. So there's a very simple formula, just 3 elements in this formula. So a project's cash flow for a particular year is equal to the project's operating cash flow minus a project's change in net working capital minus a project's capital spending. So in order to forecast my cash flow for a particular year, I am going to need these 3 elements. So the next question should be, how do I calculate these next 3 elements? Well, project's operating cash flow is equal to this formula right here. Earnings before interest and tax plus depreciation minus taxes. Okay, now earnings before interest and tax, that can be calculated easily. Depreciation can be calculated easily. Taxes can be calculated easy. So these three things will be given to you by the question. And so we know how to get this. How do I get these two things? Well, these two things will explicitly more or less be given to you in the question. It's just up to you to realize, oh yes, this is my change in net working capital. Oh yes, this is my capital spending. And we're going to look at an example which does this. Okay, so to calculate, to forecast my cash flow, I'm using this formula, and I'm going to show you how we get these three things. So let's begin with an example. Okay, we have a company and it's called Extremity. And this company wishes to undertake a project in selling masks. Alright, selling masks. We want to see, is this project worth taking? And in order to do our valuation methods, we're going to need our cash flows. And so we've made some estimates right here. We're estimated to sell 40,000 masks at $5 each. Estimated variable cost per mask is $3 each. Estimated fixed costs are $18,000 per year. Estimated to require $60,000 in manufacturing equipment, and equipment is assumed to depreciate 100% via a straight line basis. But there's a few more things that we have to look at. So look at this. Net working capital is expected to initially be $15,000. It will not change throughout the life of the project. So see how this may be alluding to what the value of this might be. And we have $100,000 initial capital invested into the project to get it started. And the life of the project will be 3 years before closing down, and salvage value is $0. Now, a typical question won't be structured in dot points as I have written. I've just done this so we can easily get our figures and coherently do our question. But normally our typical question will give you all this information, and you should be breaking it down like this, realizing what your numbers are and also realizing where they belong. Okay, now I'm going to end the lesson here because we have a lot of mathematical work to do next lesson, and so we'll do that in the next video.